Welcome to part 2 of the Smart Money Concepts course based on the Wyckoff method. If you're new to the channel, please click the like button and subscribe so you don't miss future uploads. If you haven't watched part 1, please make sure you do by clicking the video card in the top right corner. In this part, we'll be taking a closer look at the accumulation and distribution processes and the 7 logical events outlined by the Wyckoff method. Before we move on to the details of accumulation and the distribution, we have to realize that the Wyckoff method was developed for the stock market in a time when more complex financial instruments did not exist. That means that the process of accumulation and distribution is based on the absorption of a limited number of stocks floating around. In today's markets, more refined financial instruments like derivatives change this paradigm. In the futures market, for example, the number of contracts that can be traded is infinite, so the accumulation and distribution processes are based on the interest or in the lack of interest of buyers and sellers. Nowadays, most retail traders have the notion that there are different types of market participants with different degrees of power in the market. It's useful to realize that trading is a game of information, meaning that the success of a market participant is not precisely a function of capital, but a function of information. In that sense, we can separate the market into two types of players, the well-informed and the uninformed. Large traders are well-informed and more than capable of understanding the flow of the market, while retail traders are mostly uninformed, meaning that they are predominantly confused about what the market will do next. Well-informed traders are always ahead of the uninformed traders. That's why capital flows constantly from the hands of the uninformed to the hands of the well-informed. Once again, this is a matter of information, not capital. If large traders can purposefully trigger stop orders in certain places of the chart, you can avoid being a victim of such a maneuver by understanding its mechanics. In other words, the limiting factor for retail traders is not just capital, it's information. In part 1 of this course, we talked about some of the fast reversal patterns that might appear in the market: the climax, the double top or bottom, the pullback, and the bull or bear trap. However, these are the exceptions in the Wyckoff method. In the normal Wyckoff cycle, the trend changes through a slow pattern, which is the main object of analysis of this method. The reason for that is that trend-changing campaigns take some time to develop. Well-informed traders have to slowly act in order to effectively turn the market. It's time now to take a closer look at the nuances of the accumulation and distribution processes more carefully. Let's begin with the accumulation process. The accumulation is a ranging market that precedes an uptrend. In other words, the accumulation is the market phase where large traders will absorb supply, which we can see as the cause of the uptrend that will follow, known as the effect. It logically means that if large traders create the accumulation, the downtrend that precedes it is in control of uninformed small traders. As the market is driven down by the uninformed traders, large, well-informed traders gradually absorb supply in order to create a reversal. The fundamental maneuver in an accumulation process is the bear trap, which is denominated as spring in the Wyckoff terminology. The spring is characterized by a sharp movement to the downside, which breaks the lower limit or support of the accumulation range. The motivation for this maneuver is threefold: trigger the stop-loss orders of traders who manage to enter good long positions at the lower limit of the accumulation range. The stop-loss of a long position is a short position. In other words, when these stops are triggered, large, well-informed traders can take the counterpart and buy at low prices. The spring maneuver can induce uninformed traders to the downside. When traders see price breaking a support, they are tempted to sell so they don't miss out on the opportunity. Their sell orders provide liquidity to the large, well-informed traders who just want to buy at these low prices. And last but not least, the spring also serves as a way for well-informed traders to lock profits from the short positions resulting from the prior downtrend. Large traders will absorb supply until they are assured that the path of least resistance is to the upside. They can perform certain maneuvers in order to test if that's the case. This is something that you, as an observer of this process, should pay attention to. If large traders observe that downward price movements don't grab the attention of sellers, showing low volume, it's a sign that there is lack of interest to the downside, and supply has been mostly absorbed. Let's look at the basic characteristics of an accumulation. As the accumulation range develops, there is the tendency for volume and volatility to decline, generally speaking. This happens because as time passes by and large traders absorb supply, there will be progressively less interest to the downside. Volume will increase before price breaks out of the accumulation range, which is one of the signs that can be used to anticipate the uptrend. In the attempt to manipulate uninformed traders, large traders will create what is called a spring, which is a false bearish breakout intended to induce uninformed traders to sell at lower prices, just so that well-informed traders can buy more at an extremely good price. Since well-informed traders will be absorbing supply constantly, the bullish candlesticks will tend to be wider than the bearish ones. In the final stages of the accumulation, the formation of higher highs and higher lows inside the accumulation will occur to initiate the uptrend. The accumulation will finally end when well-informed traders absorb enough supply so that selling interest is very low. This will create a path of least resistance to the upside, and the uptrend will start. Let's now take a look at the details of the distribution. The distribution is a ranging market that precedes a downtrend. In other words, the distribution is the market phase where large traders will absorb demand, which we can see as the cause of the downtrend that will follow, known as the effect. It logically means that if large traders create the distribution, the uptrend that precedes it is in control of uninformed traders. As the market is driven up by uninformed traders, large, well-informed traders gradually absorb demand in order to create a lack of interest to the upside. The fundamental maneuver in a distribution process is the bull trap, which is denominated as upthrust in the Wyckoff terminology. The upthrust is characterized by a sharp movement to the upside, which breaks the upper limit or resistance of the distribution range. The motivation for this maneuver is threefold. Triggers the stop-loss orders of traders who manage to enter good short positions at the upper limit of the distribution range. The stop-loss of a short position is a long position. In other words, when these stops are triggered, large, well-informed traders can take the counterpart and sell at high prices. The upthrust maneuver can induce uninformed traders to the upside. When traders see price breaking a resistance, they are tempted to buy so they don't miss out on the opportunity. Their buy orders provide liquidity to the large, well-informed traders who just want to sell at these high prices. Last but not least, the upthrust also serves as a way for well-informed traders to lock profits from the long positions resulting from the prior uptrend. Large traders will absorb demand until they are sure that the path of least resistance is to the downside. They can perform certain maneuvers in order to test if that's the case. This is something that you, as an observer of this process, should pay attention to. If large traders observe that upward price movements don't grab the attention of buyers, showing low volume, it's a sign that there is lack of interest to the upside, and demand has been mostly absorbed. Let's look at the basic characteristics of a distribution. As the distribution range develops, there is the tendency for volume and volatility to decline, generally speaking. This happens because as time passes by, and large traders absorb demand, there will be progressively less interest to the upside. Volume will increase before price breaks out of the distribution range, which is one of the signs that can be used to anticipate the downtrend. In the attempt to manipulate uninformed traders, large traders will create what is called an upthrust, which is a false bullish breakout intended to induce uninformed traders to buy at higher prices, just so that well-informed traders can sell more at an extremely good price. Since well-informed traders will be absorbing demand constantly, the bearish candlesticks will tend to be wider than the bullish ones. In the final stages of the distribution, the formation of lower highs and lower lows inside the distribution will occur to initiate the downtrend. The distribution will finally end when well-informed traders observe enough demand so that buying interest is very low. This will create a path of least resistance to the downside, and the downtrend will start. Given these basic characteristics of accumulation and distribution structures, it's time now to move on to the 7 logical events outlined by the Wyckoff method. The Wyckoff methodology outlines 7 logical events to help the trader read the market more accurately. The main advantage in this is that the trader knows what to expect in each market scenario which can help reduce some of the uncertainty of trading. These events are the preliminary stop, the climax, the reaction, the secondary test, the false breakout, the breakout, and the confirmation. Next, we'll examine each of these 7 events more carefully, starting with the preliminary stop. The preliminary stop is the first sign that the trend might be near its end. When we are talking about an accumulation, the preliminary stop is called preliminary support, and when we are talking about a distribution, the preliminary stop is called preliminary supply. The main characteristic of a preliminary stop is the first entrance of large traders in the opposite direction of the main trend. This is usually displayed in 2 different forms, with narrow range candles that have high volume, which is a form of divergence in volume spread analysis, or with a candle that has a large tail and high volume. In other words, the preliminary stop is the first large trader's attempt to absorb orders. Let's observe hypothetical examples of that both in accumulation and distribution processes, starting with the accumulation first. The preliminary support occurs when the downtrend is still in effect, so it's usually not the lowest point in the trend. It's just the first appearance of large, well-informed traders starting to absorb supply. As I said previously, the preliminary support will appear mainly in 2 forms, either as a set of narrow range candles with constant high volume across them, or as a candle with a prominent large shadow and high volume. The high volume across the set of narrow range candles means that the supply from uninformed traders is battling with the demand from well-informed traders. The result is a high level of activity in a narrow price range. The other scenario where a large shadow appears is a little more explicit. The large shadow is a clear sign of entrance from well-informed traders on the other side of the trend. In the distribution, the rationale is the same but upside down. The preliminary supply occurs when the uptrend is still in effect, so it's usually not the highest point in the trend. It's just the first appearance of large, well-informed traders starting to absorb demand. As I said previously, the preliminary supply will appear mainly in 2 forms, either as a set of narrow range candles with constant high volume across them, or as a candle with prominent large shadow and high volume. The high volume across the set of narrow range candles means that the demand from uninformed traders is battling with the supply from the well-informed traders. The result is a high level of activity in a narrow price range. The other scenario where a large shadow appears is a little more explicit. The large shadow is a clear sign of entrance from well-informed traders on the other side of the trend. For the trader following the Wyckoff method, the preliminary stop has 2 main uses. It serves as an indication that it's no longer a good idea to trade in the direction of the current trend, and the current price level might be a good place to take profits, assuming a position was taken at the beginning of the current trend. There is the possibility of a trend having multiple preliminary stops before transitioning into a sideways market due to the inertial movement of a trend. Trying to stop a strong trend is like trying to stop a cargo ship. A lot of power is necessary, so one preliminary stop might not be enough to transition the market into a sideways movement. The climax is the second event in the Wyckoff method, coming right after the preliminary stop, and it is marked by a wide range candle in the trend direction with climatic volume. It's usually the highest high before a distribution or the lowest low before an accumulation. In the case of an accumulation, the climax is denoted as a selling climax, and in the case of a distribution, it is denoted as a buying climax. As the event name suggests, the climax will usually appear as a wide range candle with high volume, but not necessarily. The climax might also appear in similar structures to the preliminary stop, meaning a set of narrow range candles with high volume, or a candlestick with large tail and high volume. In this illustration, you can see the textbook version of the buying and selling climaxes. The confirmation for the climax can only come from event number 3 and 4, which we'll study next. In the overall sense, the climax comes after the preliminary stop. In the case of an accumulation, the selling climax will come after the preliminary support, as you can see in this illustration. In the case of a distribution, the buying climax will come after the preliminary supply. The uses of the climax are similar to the preliminary stop, It's an indication that trades in the direction of the main trend should not be taken anymore, even though what happens after the climax will determine if the trend will continue or not. Second, it's probably the last chance to take profits from the current trend trade, assuming there was one. It's also important to know that a trend might not always end with climatic volume. In that case, instead of a buying or selling climax, there will be a buying or selling exhaustion, which is the gradual decrease in volume at the end of a trend. A decrease in volume simply means a lack of interest from one of the sides of the market. Buying or selling exhaustions represent a type of divergent relationship between price and volume, or effort and results using Wyckoff terminology. A climax is not confirmed until the third event, which is called reaction, which is characterized by a sharp movement in the opposite direction of the climax. In the case of an accumulation structure, the reaction is called automatic rally, and in distribution structures, the reaction is called automatic reaction. This is a critical event because it not only confirms the climax, but it also represents what is called a change of character in the Wyckoff terminology. In other words, the reaction signals the end of the current trend and the beginning of the sideways movement. This change of character itself must be confirmed by the next logical event. The degree of the reaction is a key factor in determining if the market will indeed reverse after the sideways market or if it will resume the direction of the prior trend. A strong reaction suggests that a reversal might take place, while a weak reaction with low volume suggests a reaccumulation or redistribution. Generally speaking, the reaction will begin with high volume and end with low volume. In this illustration, you can see an example of an automatic rally, meaning the reaction after a selling climax. In this other illustration, you can see an example of an automatic reaction after a buying climax. There are three main uses for the reaction event. The first is to be used as one of the boundaries for the accumulation or distribution ranges. In the case of an accumulation, the automatic rally establishes the upper limit of the range or the resistance. In the case of a distribution, the automatic reaction establishes the lower limit of the range or the support. The second use of the reaction is to confirm the climax. The automatic rally will confirm a selling climax, while the automatic reaction will confirm a buying climax. The third use of the reaction is to provide context. In other words, if the reaction confirms the climax, now traders know that they should expect a secondary test at the level of the climax. This is very useful because it eliminates some of the uncertainty. In other words, using a method like Wyckoff has the benefit of knowing what to expect in different market scenarios. The secondary test is the fourth logical event, and it is characterized as a price movement aiming to test the level of the climax, but with lower volume and narrower candle ranges. Sometimes price will fall short of the climax, sometimes it will test it exactly, and sometimes it will surpass the level of the climax. These different situations are indications of the underlying strength of market players. The secondary test is characteristic after the reaction, and it will mark the end of what is called phase A. However, other secondary tests can occur in phase B, and they represent a challenge to traders using the Wyckoff methodology because they sometimes produce minor false breakouts. In this illustration, you can see the example of a secondary test in an accumulation structure, and in this other illustration, you can see the example of a secondary test in a distribution structure. When we talk about accumulation or reaccumulation processes, the minor false breakout of the upper limit, which is actually a secondary test, is labeled upthrust action. If price remains in a sideways motion above the upper limit of the range for a while before returning, that action is labeled as a minor sign of strength. Recall that in this context, strength relates to demand and weakness relates to supply, not to the power behind the movement. A breakout of the lower limit of the range is labeled as secondary test as sign of weakness. In the context of a distribution or redistribution, the minor false breakout of the upper limit, which is a secondary test, is labeled simply as upthrust, and a minor false breakout of the lower limit is labeled as minor sign of weakness. Don't get too worried about the correct labels though, because we can only be certain about them once we know which direction price will trend next. What's important here is the perception of a minor false breakout. Beyond the secondary test, the method also outlines what is called a generic test. A successful generic test is the one that shows lack of interest from the smart money in key moments of the accumulation or distribution process. A valid test would display low volume, while a failed test would display relatively high volume. The reason for low volume in a valid test is that the smart money has absorbed all the orders, and the market is now ready to start a new trend. In the failed test, volume is still high because uninformed traders are still trying to push price in one direction, so the smart money has to keep absorbing orders, which inevitably increases volume. We have to analyze tests in terms of volume spread analysis. In other words, to know if a test is successful or not, we need to analyze price in alignment with volume. In this context, we are looking for what are called no demand candle or no supply candle. A no demand candle is a narrow range bullish candle with lower volume than the last two candles. A no supply candle is a narrow range bearish candle with lower volume than the last two candles. The no demand candle and the no supply candle basically means a lack of interest in the corresponding direction. The false breakout is considered to be the most important event of all since it represents the best trading opportunity with the greatest risk-reward ratio in the Wyckoff method. It represents the ultimate point of the smart money manipulation maneuver. In the case of an accumulation, the false breakout is called spring, and in the case of a distribution, the false breakout is called upthrust. This event marks the end of the cause and the beginning of the effect. The false breakout happens because at the extremes of the range, different types of traders place a lot of orders, which in the Wyckoff terminology creates what is called a liquidity zone. These zones turn out to be an extremely good place for large traders to absorb a lot of supply or demand, depending on what direction we are talking about. In a false breakout, large traders make it look like the market will indeed continue in one direction in order to attract uninformed traders to trade in that direction. This is only a trick to generate liquidity so that large traders can enter in the opposite side. The key factor while analyzing a market scenario like this is to look for signs of rejection. Price needs to break a certain level and then show some sign of rejection to that breakout right after. That's how we know well-informed traders are entering on the opposite side of that breakout. This display of rejection can occur in one, two, or several candlesticks. Each case is a little different, so each market scenario must be analyzed individually. For example, in an accumulation, the false breakout is called spring, and it will induce sellers to the downside by a breakout of the accumulation support. When uninformed sellers see the support being broken, they start to sell with the fear of missing out the opportunity to make a profit. Meanwhile, the smart money is aggressively absorbing the supply in order to enter long positions at a very low price. Because of the significant absorption of supply, price action will display signs of rejection, like leaving prominent lower shadows at the accumulation support, for example. That's the smart money's footprint at the spring. In a distribution, the false breakout is called upthrust, and it will induce buyers to the upside by a breakout of the distribution resistance. When uninformed buyers see the resistance being broken, they start to buy with the fear of missing out the opportunity to make a profit. Meanwhile, the smart money is aggressively absorbing this demand in order to enter short positions at a very high price. Because of the significant absorption of demand, price action will display signs of rejection by leaving prominent upper shadows at the distribution resistance, for example. That's the smart money's footprint at the upthrust. There are three main uses of the false breakout. The most obvious one is to drive the breakout traders out of the market. These are the traders that believe it's a good idea to buy or sell on a clear breakout in the chart. This is perhaps the primary source of liquidity for the well-informed traders. The second is to trigger the stop-loss orders of other traders who happen to dwell in the liquidity zone. The third is to stop out the traders who were smart enough to anticipate the direction the well-informed traders want to trade, but entered the market too soon. In the Wyckoff method, there are two main signs traders should look for in the anticipation of a false breakout. The first sign is that the prior events must develop in a certain proportion. In other words, it's important that all the events leading up to the false breakout happen more or less in the way the method suggests. The other sign is the absence of a false breakout in the other direction. It's interesting to note that there are different degrees in which false breakouts can develop, and there is an inverse relationship between the apparent aggressiveness of the false breakout and its true power. For example, in an accumulation, a spring that breaks the support with more violence is called terminal shakeout. However, the fact that price traveled more in the direction against the smart money denotes that uninformed traders were also powerful, so the well-informed had to work harder to absorb all the supply. And a spring that only penetrates the support a little bit denotes more power, even though it looks subtler in the chart. That's because the smart money has already absorbed all the supply, and it's now ready to initiate the new trend. This is analogous to the divergent relationship between a narrow range candle with high volume. The candle looks unimportant, but the fact that there is high volume implies something useful. The breakout is the sixth event, and it represents a true breakout of an accumulation or distribution. So according to the Wyckoff method, this is the second change of character. A change of character happens when the market goes from trending to ranging mode or vice versa. In the reaction, the climax is confirmed and the market goes from trending to ranging. In the breakout, the market goes from ranging to trending. A true breakout of an accumulation is denominated as sign of strength or jump across the creek. A true breakout of a distribution is denominated as sign of weakness or fall through the ice. Notice that strength and weakness in this context are not related to the power of the movement, but to its direction. Strength is analogous to the upside, and weakness is analogous to the downside. This is a reflection of price starting to move in the path of least resistance after the large, well-informed traders have absorbed all the supply or demand depending on what direction we are talking about. The breakout is where traders should look for the harmonic relationship between price and volume in comparison to a support or resistance level that was pre-established by the reaction. What traders should look for is a breakout with high volume where the broken level holds price. Observing if the broken level will in fact hold price is absolutely critical, because if it doesn't, we might be in the face of a false breakout, which would completely change the situation. In this illustration, you can see the breakout event in an accumulation structure, also known as a sign of strength or jump across the creek. In this other illustration, you can see the breakout event in a distribution structure, also known as a sign of weakness or fall through the ice. The last event is the confirmation, which is a final necessary step because it validates the breakout. This is important because in real time, it's always difficult to know if we are dealing with a true or false breakout, and that's critical for the decision-making process. In the case of an accumulation, the breakout of the range is called sign of strength or jump across the creek. The seventh event, the confirmation, is called the last point of support. In the case of a distribution, the breakout of the range is called sign of weakness or fall through the ice. The seventh event, the confirmation, is called the last point of supply. The confirmation is usually a clear event in the chart. At this point, the trend will be in effect, and this is where the harmonic relationship between impulse and corrective price movements is expected. An increase in volume on impulse movements and a decrease in volume on corrective movements. In an accumulation, the critical moment is to wait for a confirmation formed by a no supply candle testing the support formed by the reaction, and then after that, seeing a sign of strength candle, meaning a medium range bullish candle with high volume. In a distribution, the critical moment is to wait for a confirmation formed by a no demand candle testing the resistance formed by the reaction, and then after that, seeing a sign of weakness candle, meaning a medium range bearish candle with high volume. This concludes the 7 logical events proposed by the Wyckoff methodology. Keep in mind that these events don't always occur exactly like this. There's a lot of room for variation, so it's important to keep an open mind about that. In this video, I presented the main structure of the accumulation and distribution processes and the main form of the logical events. The important thing here is to realize how the market slowly changes character and the size you can look for in terms of price and volume. That will help you to be on the right side of the market. In part 3, we'll talk about phases and structures of the market according to the Wyckoff methodology. If you enjoyed this video and thought it was useful somehow, please help support the channel by clicking the like button, subscribing to the channel, activating the notifications so you don't miss future uploads, sharing the video with your trading community, and leaving your feedback below in the comment section. Thank you very much for watching, and I hope to see you in part 3. Take care.